static, static.
No. Four times it is
इंटरनेट स्लो है सर थोड़ा.
Sir,
Omkar. Yes.
Yes, Omkar. Start.
Hello and good evening, everyone. I am Omkar and welcome to our day 8 of Direct Tax Practice session, which will be how to fill ITR, new requirements, including that of verification of ITRV, how to determine residential status for financial year 2019 and 20 and financial year 2021, definition of a person, etc. with the slab rate for all persons. Which will be initiated by CA Sumidha Devchake ma'am and organized by Vikasa Pimpri Chinchwad branch of WRC of ICI, jointly with Pune, Nagpur and Satara branches of Vikasa of ICI. I do welcome respected dignitaries, CA Shailesh Borkar, Chairman Vikasa Pimpri Chinchwad, CA Prasad Saraf sir, past Chairman Pimpri Chinchwad branch of WRC of ICI, CA Pushparaj Sangvi sir, and today's speaker CA Sumedha ma'am. Now I request CA Shailesh sir to welcome and guide the students.
Thank you, Omkar. It's my privilege to share the screen with today's session speaker, CA Sumedha Devchake, with CA Prasad Saraf, who is the past chairman of Pimpri Chinchwad branch, CA Pushparaj Singhvi, with my Vikasa team members, Omkar and Amoj. I welcome you all as a chairman of Pimpri Chinchwad Vikasa on this 8th day of direct tax practice course. Today's session would be on residential status and person definition and other basic requirement while filing the ITR. I also thank you, Sumedha Devchake ma'am, for readily acceptance, for showing her willingness and accepting our invitation to be speaker in this series of 9 days series. I again welcome you all on behalf of Pimpri Chinchwad Vikasa along with Pune Vikasa, Satara Vikasa and Nagpur Vikasa. Not to waste much time of the speaker and to have much more time for today's speaker so that they can deliberate on the issues and solve the practical issues of the students. I now hand over to Omkar for further deliberation. Thank you all.
Yeah, thank you, Shailesh sir. Now I request CA Prasad Saraf sir to address the students.
Good afternoon, everybody. It is indeed great pleasure on the today's interactive section through webinar with all the students over the various places like Pimpri Chinchwad, Pune, Nagpur and Satara. On this occasion of the virtual direct tax practice course for 9 days, it is a very welcome step initiated by the Vikasa Pimpri Chinchwad branch team. And at the outset, I am very happy when I came to aware about the total schedule from CA Shailesh Borkar, and I had personally talked with him, and it is indeed happy and share with him that the two topics I very much, though other topics are also very nicely designed and drafted, but two topics I am much more interested and I'm very happy to take on the these program schedule, that is yesterday's, that is TDS and TCS and today's, that is income tax intricacies with respect to filing of income tax return, verification and etc. As we are all aware that all we are professionals, and in our office the article staff and other people who are the backbone in our offices, for them the filing requirement, the definitions and all with respect to taxation, various slab rates are dependent upon the definition of the person. If in these places the mistakes are happen, then automatically the working and all the places it will be affected and notices will be received through online. Though the area of online and through CPC we come across various things, we are all aware. As of today's, the topic is very much important, and I'm happy that the today's speaker, CA Sumedha Devchakke madam, will deal all this topic very nicely, and it will be a very great deliberation from her, and I'm much confident that she will do it properly. At the end, I'm thankful for giving me an opportunity to the CA Simran Lalwani madam, who is the branch chairperson of the Brinchot branch, CA Shailesh Bore, who is the Vikasa chairperson of chairman of Pimpri Chinchwad branch, CA Samir Ladda, Pune Vikasa chairman, CA Akshay Gulhane for Nagpur Vikasa chairman, and Rishikesh Wangade of Satara Vikasa. All the best, take care, and happy learning to all of you. Thank you.
Definitely. Thank you so much, sir, for guiding us all. Now I call upon Ms. Amu Purushottam to introduce and welcome our speaker, today's speaker, CA Sumedha ma'am.
Good evening, everyone. Amu here. At the outset, I would like to thank Vikasa Pimpri Chinchwad branch of WIRC of ICAI and all the office bearers for giving me this great opportunity. It gives me immense pleasure to introduce our esteemed speaker today, CA Sumedha Devchakke Kulkarni madam. Welcome, ma'am. CA Sumedha Devchakke Kulkarni ma'am is currently a practicing CA in Chinchwad, being the proprietor at SS Devchakke and Associates. She qualified her CA course in May 2015. She completed her articleship from Khandelwal Jain Associates, which is formerly known as BDO MZSK and Associates. She's graduated from BMCC College. Further, she is a qualified CISA. She also has completed her certification courses on forensic audit by ICAI and the bank's concurrent audit from ICAI. Coming to the work profile, she provides all-round services to the clients right from the incorporation of the business up till audits and assessments under direct as well as indirect taxes. Thank you. Over to you,
Yeah.
Omkar.
Yeah. Thank you, Amu. Yeah, before starting the session, here is an important announcement for the students to please check their mailbox, as we have online quiz after each session with a particular topic related to the session, and with the same, we will the participant would get e-certificates. So please check the mailbox. Now I would request Sumedha ma'am to conclude further. Yeah, thank you.
Hello everyone, a very good evening to all. And before beginning, I would like to thank CA Prasad Saraf sir for his kind and wonderful words. I hope I, touch up to it. Then I would also like to thank the committee members and the program coordinators of Pimpri Chinchwad branch, Pune branch, Nagpur and Satara branch, who have jointly organized this session, this wonderful session on direct tax practice course. Then I would also like to thank CA CV Chitale sir for guiding us from time to time. And lastly, CA Shailesh Bore sir for presenting me this opportunity to speak in front of you all today. So for the past 8 days now that our series has been going on, various faculties have taken on wonderful sessions and they have explained the Income Tax Act to all of us part by part. So today's session is a rather basic one where, wait, I'll share my screen with you all first. Okay, so today's session is a rather basic one where we shall be covering how to file the ITR, its new requirements, including that to verification of ITR 5, then definition of person with slab rates for each person, and residential status. So I'll be changing the sequence a little bit for our better understanding. And let's start with the types of persons and their slab rates. So the section 231 of Income Tax Act defines person, and it says that person includes an individual. Individual being people like you and me, and people who carry on business under their own proprietorship. Then comes Hindu undivided family, that is an HUF. So the term HUF is not exactly defined under Income Tax Act, But the Hindu law states that HUF means an Hindu undivided family, which is a family that is leniently ascended from a common ancestor. So let's understand this with an example. Say Mr. A has two sons, Mr. S and Mr. D. After the death of Mr. A, all his property or all his wealth is transferred directly to an HUF instead of being divided between his two sons S and D. So whatever income that is derived from his wealth and property is taxed separately under HUF instead of being taxed under his sons separately. Then comes a company. So a company is what we are all familiar with, being a private limited company or a public limited. Basically, a company that is incorporated under Companies Act or any other act which governs companies. Then comes a firm. A firm basically means the one registered under Partnership Act, that is partnership firm, or an LLP, which is registered under Limited Liability Partnership Act. Next is an AOP or a BOI, whether incorporated or not. So AOP means an association of persons, as in any of the above listed persons who come together jointly for an income producing activity. And BOI, that is a body of individuals, wherein a group of individuals only. So this is the key difference between AOP and BOI, that for an AOP, any of the persons who come together jointly, and that too for income deriving purpose. But for a BOI, there are only group of individuals with a common purpose who come together for income deriving or for a not-for-profit business together. So that is the key difference. Then comes a local authority. Again, we are familiar with this. A local authority, that is our municipal corporations like PCMC or PMC. And lastly, any artificial judiciary person. So this basically is a residual class whereby where a person does not fit in the above categories, he is classified in the last category. Okay. Okay, so let's take a look at the slab rates for EVA 2021. Now, many of us are already familiar with these, but let's take a quick review. So, income tax slab rate for resident individual below 60 years, HUF, AOP, BOI, and an artificial judiciary person. Now, resident individual, it includes men and women. So, up to 2,50,000, he shall have no tax. Then, for income between 2,50,000 to 5 lakh, it shall be taxed at 5%. For income between 5 lakh to 10 lakh, it shall be taxed at 20%. And income for more than 10 lakhs will be taxed at 30%. Then surcharge is applicable on the tax amount at 10% of the income tax, where the total income exceeds 50 lakhs and it is up to 1 crore. Then 15% where the total income exceeds 1 crore and it is up to 2 crore. Surcharge at 25% of tax where total income exceeds 2 crores and it is up to 5 crores. And where the income exceeds 5 crores, the surcharge rate will be 37%. Moreover, health and education cess of 4% will be applicable on the income tax plus surcharge. Then comes income tax slab rate for senior citizens who have their age between 60 to 80 years. So for them, the basic exemption limit is 3 lakh rupees. So up to 3 lakhs, they have no tax. For income between 3 lakhs to 5 lakhs, they will be taxed at 5%. 5 lakh to 10 lakh, 20%. And more than 10 lakh rupees, 30%. So the last two slabs are just like the previous ones. Then again, surcharge, same as for the resident individuals, 10%, 15%, 25%, and 37% as the income slab is applicable, and adding health and education cess of 4%. Then the slab rate for senior, or what we call a super senior citizens who are of 80 years or more. For them, the basic exemption limit is 5 lakh rupees, so up to 5 lakh, no tax. Then for income between 5 lakh to 10 lakhs, 20% of tax, and more than 10 lakhs, 30% of tax. Again, surcharge, same as applicable to them. And for assessee being a resident individual whose total income after claiming all the deductions under Chapter 6A, which does not exceed 5 lakh rupees, shall be entitled to a rebate. This is basically a relaxation that the department is giving for people with low income. Rebate under Section 87A of an amount equal to 100% of the income tax or rupees 12,500, whichever is less. So one thing that is to be noted is that this rebate is applied to the total tax amount before adding up the education cess, health and education cess of 4%. Okay. The slab rates I will just quickly revise and then we'll go further. For all existing domestic companies, for companies with their turnover in 2017-18 was up to 400 crores, then the tax rate for the current financial year shall be 25%. And for companies with turnover in 2017-18 exceeding 400 crores, the tax rate shall be 30%. Again, surcharge will be applicable at the rate of 7% if the tax is up to 10 crore, and surcharge of 12% will be applicable if the net income exceeds 10 crore. Health and education says of course of 4% on income tax plus surcharge. Then comes slab rate for the foreign companies. Now in case of foreign companies, they are categorized as in case a company receives royalties received from government concern or technical fees as per agreement approved by government, then such companies shall be charged at 50%. And if the foreign company has any other income, then it shall be charged at 40%. For such foreign companies, the surcharge shall be 2% on the tax amount if taxable income exceeds 1 crore, but it does not exceed 10 crores. That is, for 1 crore to 10 crores, 2% of surcharge shall be applicable. And where the net income exceeds 10 crore, 5% of surcharge shall be applicable. Again, same health and education cess of 4% will be applied. Then let's come to next category of person, that is partnership firm, LLP and local authorities. Now for this category, there is no turnover limit or there is no basic exemption limit given. They shall be taxed at straight 30% flat rate on their net taxable income. And surcharge shall be applicable at the rate of 12% on tax if their net income exceeds 1 crore. Then comes slab rate for cooperative societies. So for these, the department has specified different slabs. That is, if their taxable income is up to 10,000 rupees, the rate shall be 10%. If their income is between 10,000 to 20,000, tax rate shall be 20%. And if income is about 20,000, it shall be 30%. Surcharge of 12% shall be applicable on tax if the net income exceeds 1 crore. Again, health and education says same for everyone at the rate of 4% on tax plus surcharge. Now, for AY 2021-22, the Finance Act 2020 has introduced a new tax slab structure. The structure is only introduced for individuals and HUF right now, whereby they are given an option to choose between the old scheme and new scheme. So let's now I am just giving a rough summary of what this scheme is. So when a client calls you up and asks whether, madam, we should opt for old scheme or new scheme, don't just give an answer directly. Let's ask them about their income sources, ask them about their investments, and only then give answers. Let's take a look at what the new slab rates are. So when the income is up to 2.5 lakhs, it is same in both the schemes, that is nil, no tax, basic exemption limit that it is. Then for income between 2.5 lakhs to 5 lakhs, in both the schemes, you shall be taxed at 5%. Again, there is no change here. Now, next 5 lakh to 7.5 lakh. This is a new slab that has been introduced. When taxing in the old scheme, the individual was taxed at 20%. But in the new scheme, you shall be taxed at 10%. But of course, to get taxed under a lower rate, there are a few more conditions which I'll be taking up in the next slide. Then for income between 7.5 lakh to 10 lakhs, in the old scheme you will be taxed under 20%, but in the new scheme you will be taxed under 15%. Next slab, that is 10 lakh to 12.5 lakh. These are some new slabs that have been introduced. So for 10 lakh to 12.5 lakh, in the old scheme you will be taxed under 30%, but the new scheme has given you a lower rate of 20%. Then for income between 12.5 lakh to 15 lakhs, again in the old scheme you are taxed directly at 30%, the new scheme gives you a rate of 25%. And for lastly, for income above 15 lakhs, in the old scheme you were taxed at 30%, the new scheme also you will be taxed at 30%. What are the conditions on the basis of which you will be deciding that exemptions and deductions are not allowed in the new scheme? Because in the new scheme gives us a lower tax percentage. Of course, they'll give some conditions. So that is that I've given an illustrative list of the exemption and deductions which shall not be available in the new scheme if you want to get taxed at a lower percentage. So the standard deduction, I'm pretty sure all these deductions and exemptions were covered in few of the previous sessions. Let's take a look at those. Like the standard deduction of 50,000, which the salaried employees would get, will not be available. House rent allowance will not be available. Then the housing loan interest, that is interest of 2 lakh rupees, which was available as a deduction under income from house property, that shall not be available. Then whatever investments the person was doing under section 80C of 1.5 lakh, that will not be available. Leave travel allowance will not be available. NPS contribution of 50,000. Then medical insurance premium under section 80D of 25,000 or 50,000 for senior citizens will not be available, and so on. All the list that has been mentioned, these deductions will not be available. So whatever is your, say, gross income without exemptions and deductions, the tax rate will be applied on that. Okay, so like I said, if your clients ask you about this, first ask them questions about their income source, ask them about what investments they have already made, and then take time from them, make your own rough calculation, read the scheme once again, and only then give your answer about whether, or give your opinion on whether they should go for old scheme or new scheme. And of course, consult your seniors and your office partners before giving any opinion. Don't just directly jump onto any conclusions. Okay, so this brings us to our second topic for the session, that is how to fill the ITR. It's some of the new requirements and up to verification of ITR 5. Okay. So before starting on how to fill the ITR, let's take a quick glance at what ITR is applicable to which category of person, the definition of person that we just learned. So let's see what type of ITRs are applicable to them. So ITR 1 is applicable for individuals having income from salaries, one house property, and income from other sources. And they are having income, total income up to 50 lakhs, sorry. So if you fit in this category, the individual shall file ITR 1. Then comes ITR 2 for individuals and HUF not carrying out business or profession under any proprietorship. So basically they can have any other source of income other than business and profession. For such individuals and HUF, you have to file ITR 2. Then comes ITR 3 for individuals and HUFs not for individuals and HUF having income from proprietary business and profession. So this one is for the business entities. I think and ITR 3 is already covered schedule by Gauri in her previous session. Then comes ITR 4, that is for presumptive income from business and profession. Again, presumptive income session is also done. Prajakta ma'am has given a good technical session on that. Then comes ITR 5 for persons other than individual HUF company and other than person filing form under ITR 7. Then next ITR is ITR 6, that is for our companies being public limited or private limited. And ITR 7 for persons including companies who are required to furnish return under section 139 4A, 4B, 4C, 4D, 4E and 4F. Now this category includes our trusts, political parties and such other parties. Okay, so like Sir mentioned in our welcome session that choosing which ITR to file is very important, because if you go wrong over there, your whole return is defective. Okay, so let's take a look at ITR 4 and then I'll explain the basic provisions on what is to be filled where and how is it is to be filled. Just give me a minute to open the file. Okay, so this is our ITR 4. I hope it is visible to everyone. This is the utility that I have downloaded directly from our income tax website. Okay, so starting off, you have to fill the basic information, that is the party's general information. Fill the name, middle name, last name, PAN, fill the address properly. Make sure that you're filling in the correct details. Double check if you want. Do not just take the last year's ITR and then copy paste the information from one form to other form. There could be changes. There could be changes in address or any other details. So always confirm those details from your client. Don't blindly just copy paste. Then you have to fill the address, give your date of birth, fill the status, whether you are an individual, HUF or a firm. Then fill your email addresses, fill the client's email address, mobile numbers, Aadhaar number, or if Aadhaar is not available and you have applied for Aadhaar, then there is the enrollment ID. You have to fill in that. Then select for the nature of employment, whatever applicable. In case salaried employee is there, then select the correct section under which you're filing the return, whether it is 139.1, it is 139.4, that is you're filing it after the due date, or if you're filing revised return, then select the appropriate section. Many of us forget to select this, or we ignore this part of the form. So if it is a revised return, then you have to fill in the, if you click on revised return, additional information, number, then the filing original return, all such details are needed to be given. Okay, if we are filing it in response to some notice, that is assessment notice received under 139.9 or 142.1, then you have to mention the date of such notice or order. Then there are a few more questions that the ITR asks us, that have you deposited amount or aggregate of amounts exceeding 1 crore in one or more current account during the previous year. Then have you incurred any expenditure amounting to 2 lakh rupees for foreign travel for yourself or any other person? You have to answer that. Then next is, have you incurred expenditure on electricity consumption of more than 1 lakh rupees? So basically what the questions are, that if any of the answer is yes for these, you have to compulsory file your ITR even if your income is below your exemption limit. So say you have an income of 2 lakh rupees and your basic exemption is 2 lakh 50. but you have say you have incurred expenditure for a foreign trip which amounts to more than 2 lakhs, or any of the three conditions, your answer is yes, then you have to compulsory file the ITR. Then in case you are filing it through a representative, you enter that details, enter his PAN, enter his Aadhaar. So part B, here it starts the computation of total income. One by one, all the income sources shall be mentioned. Firstly, because this is ITR 4, which is for presumptive income from business and profession, this income. For this, there is a special schedule. You have to fill that first and then enter the income here. Then if income from salaries is applicable, enter those details, house property, other sources. So this is basically your full computation of gross total income. So let's go to the next schedule. Details of from business and profession in case of presumptive business income. Here, properly mention the name of the business, its business code, whatever category the business falls in, and in description, you can describe the business or give the name of your business, whatever concern name is. Then comes the gross turnover or gross receipts. So, right, because presumptive income is based on your gross receipts, you will be taxed directly at 6% or 8%, whatever the applicable rate is. So you enter those amounts accordingly. And if you wish to declare your profit lesser than the above rates, then it is mandatory to get your firm audited under section 44AB. So the first section was section 44AD for all the business income. Then section 44ADA, which is newly introduced, that is for income from profession for all the professionals. Again, the same details you have to fill, that is the name of the business code, and its description. You can write what category or what kind of services are provided. And yeah, secondly, you have to enter the gross receipts, and for as you all already know, for professional income under section 44AD, you will be taxed at 50%. And the third category that is there in presumptive income, section 44AE, that is presumptive income from goods carriage under section 44E. Yeah. So again, fill in the basic details, then fill in the details of goods carriage, that is its registration number, whether it is owned, leased, or hired, then its tonnage capacity, then the number of months for which it was owned, leased, or hired by the assessee, and then the presumptive income shall be calculated as per the provisions. So make sure you have all these details available from your client. Otherwise, ask for all the details first before beginning the process of filling the ITR. I am again going to mention that do not rely on last year's information, because this is one of the mistakes that happens in many of the CA firms, that we do not see what is written. We just open the last year's form, copy paste, and we feel our work is done. So I'm going to keep stressing on the fact that do not rely on that information. Always confirm the important points from your client. Then for E9, this is a new schedule that has been introduced in the ITR. That is, you have to report your turnover that you have already filed in your GST returns. So you have to mention your GST number and the annual value of outward supplies that is mentioned in the GST returns. So this is basically the linking between your income tax return and your GST return. So make sure you are filling correct amount in both the returns. And then the financial particulars of the business, as this return is for presumptive business and profession incomes, your assessee is not required to maintain all the books of accounts, but a few details are mandatory. That is, see Schedule E15, that is for sundry creditors. You have to mention the amount of whatever sundry creditors are. Then E19, that is inventories, the amount of inventories held by the assessee. E20, that is your receivables, sundry debtors, and E22, whatever cash in hand is available with the assessee. These 4-5 schedules are mandatory. Other than that, other details you may not mention. And then the next schedules, okay, that is relating to TDS. Make sure you check the Form 26AS and then fill in the details accordingly. Then the details of advance tax and self-assessment tax paid. Get the challan copies from your client. If TCS, if any, check it from Form 26AS again. And lastly, you have to mention details of bank accounts held by your assessee, the IFSC code, name of the bank. Over here, you have to mention the list of all the accounts that are held by that particular person. Details of investments, if any, made under Chapter 6A. Over here, this is a new column which has been introduced this year because for making the investments, because of our pandemic, the due date was extended. Every year the due date is 31st March, but this time it was extended further from 1st April 2020 to 31st July 2020. So whatever amount of investment you have made between that particular months, 4 months, so you have to mention that amount separately over here. So make sure you ask this also to your client. Then your Mediclaim details. And if any donations are made, you have to enter those details. And then coming up to our basic form. After filling in all the schedules, all these chapter 6A deductions and everything shall be system calculated and our computation shall be ready. Okay. So this is just a general idea of how and where to fill in the details. Okay. Yeah. So now let's see what are the common mistakes that are generally done and which are to be avoided while filing of the ITR. So firstly, like I mentioned earlier, selecting the right form of income. If the ITR that we are using, if that is wrong, then the return shall be termed as defective. And if your ROI is defective, it is of no use. Then not reporting income from investments. Now, generally, this happens in a lot of cases. Say for when you have to file ITR for a salaried employee, he provides you with his Form 16 and he asks, ki, karo, mera return file kar do. So in cases like this, we need to find out whether he has any other income source. Like we have to ask him whether you have any FDs made, if you have any RDs made, and if you have earned interest on your savings bank account. Now, one way to find this out is through his 26 years. So if banks have deducted any TDS, that income shall get reflected over there. But where interest amount is lower than the mandatory limit, you won't find it over there. So always ask them about whatever investments are made by them and ask them to get a interest certificate from the bank so that you have a documentation with you as well. And always mention the interest amount in the ITR, whether it is say more than the exempted limit, or even if it is less, you have to mention that amount. Like yeah, the next point is not reporting the exempt income in ITR. So the income tax law requires a taxpayer to report all the income, whether it is exempt from tax or not. So exactly, so you mention all your income, whatever you have received, whether it is taxable or not. Say you have received dividend that is exempt, or you have some agricultural income, you have to mention all those income sources in the ITR, even if they are not taxable. Then comes clubbings, not clubbing the incomes. So according to the Income Tax Act, there are certain instances where the taxpayer is required to club the income, say of his minor child or his spouse, with his income, and then pay the taxes accordingly. Now, even this, many a times this gets omitted because, say, a person for diverting his income, he opens up an FD account or an RD account in the name of his minor child or his spouse who does not earn any income, or say she is below he or she is below the exemption limit. They divert their income to such people's account. So here, whatever income that is derived from such diverted income needs to be taxed in the individual's account, and then pay the taxes accordingly. So over here also you have to ask them if they have made any FDRD again, same, or invested any shares in the name of their spouse or say their minor children. Because if the department finds out later on that there was some cases where there was diversion of income, you are going to face a huge demand and penalties. Then comes not reporting income from the last job. Many a times during the financial year, an individual switches job or changes his workplace, and while filing of return, he provides only one Form 16, say of the latest employer, but he misses out on the previous employer. So in such cases, if the individual has switched jobs in the respective AVAC, then the income from previous job must be reported along with his current job. So you can find this out when you get the Form 16 of your, when you get his Form 16, where he has given only the latest jobs, Form 16. You can see that, or from the TDS certificate that we get, you can see that there will be only 2 or 3 quarters mentioned on it, and one of the quarter will be missing. So in such cases, you have to go back to the client and ask him whether in the first quarter whether he was unemployed or if he was working somewhere else. You have to ask those questions. Make sure you have the complete information before starting with the filing process. Then not reporting all the bank accounts, like we just saw, we have a separate schedule whereby you have to list out all the bank accounts held by the assessee. So while filing ITR for from financial year 14-15 onwards, the taxpayer is required to report all his bank accounts. So earlier, the assessee had to mention only one account whereby he receives or where he wishes to receive his refund, where he wants the refund to get credited. But from financial year 14-15 onwards, you have to mention the full list of bank accounts, and then the ITR gives you an option where you can give the preference for where you want the refund to be credited. But you have to mention all the accounts. And lastly, failing to revise your income. So if you have discovered an error after filing your tax return, then you must rectify your mistake immediately. Say you are filing your return and you mentioned your salary source, you mentioned other sources, you mentioned house property, but there was some share trading done by you. There was some sale and purchase of shares, and say you have some minor capital gain, or say you have loss, whatever it is, but you missed to mention that source of income. You found out that on your own, you go and immediately revise the return. Do not wait for the department to come and tell you, and then instead of facing the whole demands and penalties issues, if you find out voluntarily that yes, this is missing or I have omitted some information in my ITR, you have to immediately go and revise the return. Right. So after the whole return filing process is done, say you have submitted your return, it is not complete unless you verify it. So one of the important changes that are affected in ITRV from this current this AVI, that is AVI 2021, that after submission the ITR will be displayed with a watermark as not verified until the same is verified either electronically or by sending the same via post after manual signing. So earlier, once you submit the return, your ITRV was generated, and there was a small line at the end that this ITR is pending verification. But that ITR you could use for your further submission. Say you want to submit it in the bank or anywhere else. But now from AY 2021, you there will be this watermark that will be present on your ITRV that it is not verified, and until it is not verified, it is not considered as a valid return. So and yes, if the ITR is uploaded with digital signature, then directly your final ITRV without any watermark will be generated. But in case your verification is not done, the unverified acknowledgement will be titled as Indian Income Tax Return Verification Form, where either you then verify it online or you sign that form and send it to CPC Bangalore. And your final ITRV that is generated shall be titled as Indian Income Tax Return Acknowledgement. So that is your final acknowledgement. Again, there is a time limit that is there, that if you're opting for manual verification, if your online EVC or say the OTP is not getting generated, or if there are any other technical issues, so you can always send a manual copy, signed copy of ITRV, and you have to send it by post only. Send it within 120 days of filing the return to CPC Bangalore. And one more important point we have to note is that if the ITRV is received beyond 120 days, then the date of receipt of your ITRV shall be considered as the date of filing your return. That means your date of filing return could go beyond your due date. Even if you have submitted the return early, but you did not verify it within the 120 days, then your date of return could change. So make sure you are complying with this provision, and within 120 days you are sending the copy of ITRV, signed copy of ITRV. Now in the recent circular, Income Tax Department has given an opportunity that if you have missed out on verification of any of your previous ITRs from I think AY 1516, so you can verify those from AY 1516 to AY 1920. You can verify any of those previous ITRs up to 30th September right now. If you have missed that time, this is a good opportunity, so that, because if you do not verify it, and if you check your old ITRV right now, it shall bear a watermark as invalid return. So to change the status of that, this is a good opportunity that has been provided, and verify all the pending returns immediately. Right. Now coming, as we saw, there is manual verification and e-verification. So e-verification can be done in two ways, that is via Aadhaar OTP or via EVC, that is electronic verification code. For opting for Aadhaar OTP, it can be done only if your mobile number is linked to your Aadhaar. So while you have applied, or while you are applying to Aadhaar, make sure that correct mobile number is given and correct mobile number is linked to Aadhaar. Again, in this case, your PAN and Aadhaar should also be linked, and your mobile phone and Aadhaar should be linked. If all this is complied with, then you can go for Aadhaar OTP, or the Aadhaar OTP will be generated. Otherwise, it won't get generated. Then next way is EVC. The EVC can be done via three options, that is via net banking, via bank account number, and demat account number. So again, like I said, it is important to have all accurate details entered in order to successfully verify using the above methods. And it is also a best practice to send a copy of ITRV to CPC Bangalore immediately after submission of return if your OTP is not generated. Better you send it by post immediately, and later on if your technical issues are resolved, you can always go for e-verification. But instead of missing the deadline, it is better you send it early or as early as possible. Yes, so I've taken some snapshots from the income tax portal so that you can understand better. For e-verification, after submission of your return, when you go for e-verifying, you get these three options. That is, you already have an EVC. Option 2 is I do not have an EVC and I would like to generate EVC to e-verify my return. And option 3 is you can go for Aadhaar OTP. Right. For Aadhaar OTP, the steps are simple. You click on this option 3 that I would like to use Aadhaar OTP, and the window pops in wherein whatever mobile number is linked with the Aadhaar portal, an OTP is sent to that. And in case of EVC, like I said, you have three options. You can go through net banking, through your bank account number, and through demat account number. So if you choose to go via net banking, these steps, now I'll tell you the practical steps that you follow is ask your SSC to log into his net banking portal. Over there under services, you can, there is an e-verify direct tax return or income tax return. The option is visible. Go to that. You have to enter your basic details, and then the portal redirects you to your income tax login. Login over here, and if your details are matched, that your name on your income tax portal, your name registered in your bank account, then your mobile number, your email ID, if all these details are same under both the portals, then your EVC is generated. So if you want to generate it, if you don't have if your SSC does not have a net banking and he wants to go through a bank account number, so for that you have to pre-validate the bank account number first. So for pre-validation, once you log in into your SSC's account, you go to profile settings menu and select pre-validate. So while pre-validating, the portal asks you for the details, that is your PAN. Again, the PAN must match the PAN that is linked to your bank account number, which you're trying to validate over here. Then your name in your PAN and the name to your bank account number both should match. Then mention your account number, the account type, IFSC, your bank name, branch name, mobile number, and email ID. Again, like I previously stated, your mobile number and email ID should be the same that you have linked to your bank account. And then you go for pre-validate. Your details will be verified and then your account shall be validated. And if there is some issue in it, here they have given an option to view failed bank accounts. Like wherever there is a mismatch, say in your name or your mobile number or the email ID provided to income tax filing portal and email ID registered with the bank, say it is different, then your pre-validation will be failed and you can check the list over here. Once the bank account is pre-validated, after say few days, you can go and check it again in your profile settings. The pre-validated bank details are visible here. If it is successful, see your status becomes validated. And after that, you have this option of enable EVC. You click on that and your EVC will be generated, and via which you can verify your return. Okay, I can see there are some questions. Let's just take up all the questions at the end of our session. We'll keep a separate 15-20 minutes for that, and I'll clear all your doubts. Okay, and EVC through Demat account. Over here again, like you validated your bank account number, you have to validate your Demat account. If you wish to generate the EVC through Demat account, you have to give the details, just like how you give details for your bank account. Enter the PAN. Again, this PAN should match with the PAN linked to your Demat account. Then your name, depository type, mobile number, and email ID. Same rules for this, that all the details that are registered with the income tax portal, they should match the details registered with your Demat account. If they match, your account shall get pre-validated successfully, and then you can generate the EVC. And if it fails, then you have to try some other option, or better way, go for a manual verification. Send a signed copy to CPC. Next slide. Right. So this concludes our topic for ITR filing and verification of the same. I hope I am clear with all the provisions. And let's start with the third topic for our session, that is residential status. Right. So now what is residential status? Its meaning and the importance. So the taxability of any individual in India depends upon what his residential status is for that particular financial year. So that basically means that the residential status can be different for one financial year, and the same could be different for the next financial year. So you have to make sure that you determine the residential status for an assessee every year, especially for those who keep traveling for, say, employment purposes, or who have taken up projects abroad and they have to keep traveling, say, have a long stay abroad for 6, 7, 8 months, or they come back and then they go again. Make sure that you are checking their residential status every year. Now, the term residential status has been used by the law, and it should not be confused with the individual's citizenship. The citizenship could be for India, or it could be for any other country, but his residential status shall be determined according to the provisions of our Act, and he could be a resident. An individual may be a citizen of India, but he may end up being a non-resident for that particular year. And similarly, a foreign citizen who has a citizenship of a country outside India, he could end up being a resident for income tax purposes for that particular year. Then the residential status for different types of persons, like we saw in the definition of persons, that is individual, HUF, company, firm. For all these persons, the residential status is determined differently. Different provisions are stated in our Act. So let's learn about that one by one. Section 6 of the Income Tax Act particularly states the provisions for determining the residential status of an individual. So let's begin with the residential status for an individual. So how to determine the residential status? The Act has classified the taxable persons under 3 categories. That he could be a resident, he could be resident but not ordinarily resident, and third category is a non-resident. Again, whatever your residential status is, the taxability depends upon that. Only individuals and HUF can be classified under resident but not ordinarily resident category. For all other class of assessees, it is either resident or non-resident. So say if you are determining the residential status for a company or a firm, they are categorized only as residents and non-residents. But for individuals and HUF, there is a third category, that is resident but not ordinarily resident. We'll see what that is. Let's take a look at the provisions. Okay. Now the residential status for an individual, and the individual would qualify as a resident in India if he satisfies any one of the following two conditions. What we say is these are the two basic conditions that are stated. So if he qualifies any one of that, his status shall be resident. If he does not qualify for both the conditions, he shall become a non-resident. So first condition is that his stay in India for that particular year is 182 days or more, or his stay in India for immediately 4 preceding years is 365 days or more, and 60 days or more in the relevant financial year. Okay, so a particular individual, he has to satisfy any one of these, that in that particular year, either his stay should be 182 days or more, or the second condition states that he should have stayed in India for 60 days or more in that particular financial year, and in the preceding 4 financial years his stay should be 365 days or more. And if he fits into, or you say satisfies any one of these two categories, he shall be qualified as resident. And if both the conditions are not satisfied, he shall be categorized as non-resident. So, okay, so like I said, if any one of the above condition is satisfied, the assessee is classified as resident. Further, once he qualifies as a resident, there are two additional conditions to determine whether he shall be a resident and ordinary resident, or resident but not ordinarily resident. Like we saw that this third category of resident but not ordinarily resident is for individuals and HUF only. And to determine whether they fit into it, there are two more additional conditions. So a person, individual, shall be an RNOR, that is resident and not ordinarily resident, if he satisfies any one of the below mentioned conditions. That he has been a non-resident in India in any 9 out of 10 immediately preceding years. So you have to check his residential status for last 10 years, and you have to see whether he has been qualified as NR in 9 out of 10 years, or he has stayed in India for 729 days or less in the last 7 years. In the 7 immediately preceding years, you have to check his number of days of stay in India. So if he qualifies for any, like he satisfies any one of the two conditions, he shall be categorized under resident and not ordinarily resident, and he shall be taxed accordingly. But he does not satisfy any of the above conditions, that is, he fails to satisfy both the conditions, then he shall be classified as resident and ordinary resident. And lastly, individual satisfying neither of the conditions above, like he doesn't satisfy all the 4, he shall be classified as non-resident for that particular year. Okay. So for a better understanding, let's go through this flow chart. So for a particular individual, he has stayed, if the stay, you ask these questions, is stay in India for more than 182 days in the financial year? If yes, he is a resident. If no, you check the next condition, whether he has stayed in India for 60 days or more in that particular financial year, and he has stayed in India for 365 days or more in the last 4 years. Check if these two categories, check if he fits into these categories. If that answer is yes, then he qualifies as a resident. But if that is also no, say your first condition, that stay in India for 182 days or more, your answer is no, and for your second condition also your answer is no, you become, the residential status becomes non-resident. But if like we saw earlier, if any of these two conditions is satisfied, the assessee qualifies to be a resident. And then further we check for the additional conditions to determine whether he is an ROR or RNOR. So once you have determined that yes, out of the two conditions, either one of it is satisfied and you are a resident, then you go further on. that are you a non-resident in 9 out of 10 preceding financial years? If your answer is yes, then the individual qualifies to be a RNOR, that is resident and not ordinary resident. If this answer is no, then you check the next condition, whether your stay in India is for less than 730 days in 7 preceding financial years. Again, if your answer for any of the two above conditions is yes, the individual qualifies to be an RNOR. But the answer for both the above conditions is no. That the individual is not a non-resident for 9 out of 10 preceding years, and his stay in India is also not less than 729 days in the 7 preceding years. Then the individual shall be qualified to be a resident and resident and ordinarily resident. For easy understanding, I think you can remember this flow chart or note it down somewhere easier, so it is easier to answer the quiz later, which our branch has mailed to all the students already. Okay, so now the conditions that we went through just now, there are a few exceptions. That is cases where the first condition, which is of stay in India for 182 days or more, must be satisfied. That is like what we saw earlier is any of the two conditions are satisfied, the individual qualifies to be a resident. But in these exceptional cases, the first basic condition of stay in India for 182 days must be satisfied. If that is not satisfied, you directly the individual is qualified under non-resident. So what these exceptional cases are, let's see. The first one is Indian citizen who leaves India as a member of crew on an Indian ship or for purposes of employment outside India, or an Indian citizen or a person of Indian origin engaged outside India in an employment or business or profession who comes to visit India during that relevant previous year. So an individual who is, say, a member of a crew on a ship, or who goes outside India for employment purposes, for them they fall under these exceptions, and for them the first basic condition is mandatory. So if they satisfy that condition, they shall be qualified as resident, and then additional conditions can be applied to them. But if they do not satisfy the first condition, they shall be categorized as non-resident. Let's understand this more with an example. Say Mr. Q is an Indian citizen and he is a crew member of Singapore-bound Indian ship. His date of joining the voyage on the ship was 6th June and the date of signing off was 9th December 2019. Then his stay in India for the last 4 years was 400 days and last 7 previous years was 750 days. So let's calculate his residential status for AY 2021. Okay, so let's calculate his number of days outside India first in our relevant year. So he was on the voyage from 6th June to 9th December, which becomes 187 days. So for 187 days he was out of India. So let's do the math that Mr. Q has stayed in India for a period of 179 days. So like we saw, the first condition of stay in India for 182 days or more is not being satisfied. And therefore, without applying the further conditions, we can directly say that as he has stayed for less than 182 days in India, his status shall be non-resident for that AY. Okay. This is just for the two exceptional cases. That is, if he is a member of crew or he is going out for employment outside India, or Indian citizen who is engaged outside India in course of employment or business or profession. After individual, let's move on to the residential status for HUF. Now for an HUF would be a resident in India if the control and management of its affairs is situated wholly or partly in India. So basically, the HUF could be controlled totally from India or partly from India, partly from a place outside India. The residential status would be resident. And if the control and management of its affairs is situated wholly outside India, only in such cases the HUF shall become a non-resident. Okay, so if the HUF, let's quickly revise again that if the HUF will be a resident if its control and management is situated wholly in India or partly in India, partly outside India. Now here control and management means a place where the controlling power is, where the head and brain of that particular firm is situated. It doesn't matter from where the business is carried out or where it doesn't matter where the day-to-day activities or say where your employees are working or your laborers are working, that place is not relevant. What is relevant is where the control and management or where the central management of the firm is located. The location of that shall be used for determining the residential status of the HUF. And like we saw earlier, that the RNOR status, which is applicable for individuals and HUF only. So for an HUF to classify under RNOR, the condition is that if the Karta of the resident HUF classifies to be RNOR, the resident HUF shall also be classified as RNOR. So the residential status of HUF, see the first condition that to be a resident, it has to the control and management of its affairs should be situated in India or partly in India. If this condition is satisfied, so the additional condition to check whether the resident HUF is resident and ordinary resident, or if it is RNOR, that is resident and not ordinary resident, the condition that we have to apply is to check whether it's Karta, the Karta of that resident, if he classifies to be an RNOR. Now to check the residential status of this Karta, we'll be going through this flowchart only as applicable to individuals. We'll check if the Karta fits into any of these conditions. His residential status shall be relevant to check the residential status of that HUF. So if he is RNOR, the Karta of that HUF is RNOR, the resident HUF shall also be classified as RNOR. Okay. This is another flowchart through which we can have a clear understanding of residential status of HUF. So let's see, residential status of HUF, if its control and management is in totally in India or partially in India, it shall classify as resident. And if the control and management is completely outside India, it shall classify as non-resident. Now, if you have already classified as resident, further conditions that you have to apply is that whether the Karta is classified under resident and ordinary resident. If Karta falls under this category, then the HUF also falls under resident and ordinary resident category. And if the Karta is RNOR, then similarly the HUF also falls under the category of resident and not ordinarily resident. And then the taxation provisions shall apply accordingly. Then comes the residential status for a firm, AOP and BOI. So for a firm, AOP and BOI, it is said to be a resident in India in any year. In a firm basically is a resident, except where during that year the control and management of its affairs is situated fully outside India. So previously what we saw is, say for an HUF or for an HUF basically, if the control and management was totally or partially in India, it was said to be a resident. Here we had two categories. What the provisions for a firm AOP BOI states that a firm AOP and BOI is always a resident in India unless except where the control and management is situated fully outside India. So So in case of a firm, the control and management is in the hands of its partners. And therefore, if the partners generally meet in India regarding the affairs of the firm, say the partners stay abroad, they are situated outside India, but they come and meet in that once a year or twice a year regarding the affairs of that firm, then the firm shall be said to be the resident in India. If the control and management of affairs of these entities is wholly outside India during that year, then they are said to be a non-resident. So, in other words, to be a non-resident, no part of its control and management should be in India. So, the residential status for firm and AOPBO is easy. Basically, they are always a resident in India, unless where in that particular year the control and management is situated totally outside India, only then they are categorized as non-resident. Otherwise, they are always resident in India. Even if the partners have, say, their permanent residence outside India, but they come and meet in India and discuss the affairs of the firm or take strategic decisions of the firm shall be categorized under resident of India. Same applies for AOP and POI. Now let's check the residential status of a company. For a company, an Indian company is always resident of India. Like we saw previously, just like that, for a company also, an Indian company which is incorporated in India, it shall, or whether it is incorporated outside India, but under the Indian law, then such Indian company is always a resident in India. Even if an Indian company, it is controlled from a place outside India, or even if its shareholders of that Indian company controlling more than 51% of voting power are non-resident, or if they are located outside India, the company, because as we know, the company is a separate entity over here, and the company shall be a resident in India, no matter no matter where it is located or where its majority shareholders are or the directors are, and no matter if they are non-residents, the Indian company shall always be a resident. And it shall be, of course, taxed accordingly. So basically, an Indian company can never be a non-resident. So that category of non-resident is not applicable at all to our Indian companies. Now let's check the residential status of a foreign company. Now for foreign companies, they are categorized as per their turnover limits. That is, if the turnover or gross receipts of the particular foreign company, if it is more than 50 crores, there are two conditions to determine its residential status. That is, a foreign company, and this condition is with effect from AY 1718. That is, a foreign company is a resident in India if its place of effective management during that previous year is in India. For this purpose, place of effective management means a place where key management and commercial decisions that are necessary for the conduct of business are made. So yes, that is where, say, your board is, or wherever the strategic decisions are taken, that is the place of effective management. And if the effective management is in India, then such foreign company shall be considered as resident in India for taxation purposes. And also don't forget that the turnover limit is applicable, and these conditions are to be applied only when your gross receipts or the gross receipts of that foreign company or its turnover is more than 50 crore. And if the turnover or gross receipts is less than 50 crore, then for such foreign company, the condition is that from AY 1718 onwards, a foreign company whose annual turnover or gross receipts is less than 50 crore, it cannot be a resident in India. So this category of foreign company shall always be a non-resident, no matter where its effective place of management is. It shall be categorized as NR only. Okay. So let's sum up again that for a company, Indian company will always be a resident in India, no matter where its shareholders are, or from, or even if it is controlled from a place outside India, the Indian companies will always be a resident. There is no category of non-resident for an Indian company. Now, for foreign companies, there are two parts. That is, yeah, there are two parts. That is, if their gross receipts or turnover, if it is more than 50 crores, you have to check where the effective place of management is. It shall be the foreign company shall be a resident if its place of effective management is in India. And the second category, that is, if the foreign company's turnover is less than 50 crores, then such company will always be a non-resident. There is no question of being resident in India over here. So when you're determining the residential status for an Indian company, you have an easy answer, always resident in India. For a foreign company with turnover less than 50 crore, again, easy answer, always non-resident in India. Only the middle category, that is, if a foreign company whose turnover is more than 50 crores, you will have to check where the effective place of management is. If that is in India, then such company shall be classified as resident, and if not, if the effective management is outside India, then it shall be a non-resident company. Okay. So let's understand all these provisions that we just went through. To get a better understanding, I have taken up some examples which will, I think, clear all your doubts and give you a better understanding of the provisions. So Mr. DRV is a business head for Asia Pacific regions for a private firm. He was born and brought up in India, and he has to travel to various locations of the continent for business purposes. He has spent 200 days traveling outside India in the current financial year. Also, he has been traveling abroad from the past 2 years and has stayed out of India for about 400 days for the past 2 years. So determine his residential status for EVA 2021. Okay. So Mr. DRV, so he is obviously an individual, and let's go back and take a look at the basic conditions. That was, an individual would qualify as a resident of India if he satisfies any one of the two conditions. That is, his stay in India for a year is 182 days or more. Let's see, for that year, he has to travel and he has spent 200 days outside India. So obviously, the first condition is not satisfied. Then we check the second condition. His stay in India for 4 preceding years is 365 days or more, and 60 days or more in the relevant financial year. So has he spent 60 days or more? Yes, he has spent 200 days traveling outside India. So that means he has spent 165 days in India. So 60 days or more condition is satisfied. And let's check whether in the immediately 4 preceding years, his stay was 365 days. So as the question states that for the past 2 years, he was traveling and he has stayed in India for 400 days. And we can assume that before those 2 years, his stay was in India itself. So it definitely satisfies that condition, that in the immediately 4 preceding years, he was in India for 365 days. So the second condition is satisfied, and therefore his residential status shall be resident. And as the further information is not available, we won't go up to the additional conditions. I'll take another example to check those. Yeah, so the second one, Mrs. Kit, a citizen of India, is an export manager of AOB Overseas Limited, an Indian company, since 1st of May 2014. She has been regularly going to USA for export promotion, and she has spent the following days in USA for the last 5 years. So her information for the last 5 years has been given, and we have to determine her residential status for EVA 2021, assuming that prior to 1st of May 2014, she has never traveled abroad. Okay, so again, let's take a look at the basic condition that stay in India for 182 days or more. Let's see. In that year, that is financial year 1920, she has spent 294 days abroad. So the first condition is not satisfied. But the second condition, that the stay for immediately 4 preceding years is 365 days or more and 60 days or more in the relevant year. So let's do the math that in the immediately 4 preceding years, that is 365 into 4 years, 1460. So out of that, we have the relevant information of the number of days that she has spent abroad. So let's reduce those. That is 294, 311, 271 and 150, which equals 434. That means that in the immediately 4 preceding years, she has stayed in India for 434 days. And of course, 60 days or more in the relevant financial year. So both of these are satisfied, and therefore the second condition is satisfied. So as a second basic condition is satisfied, her residential status shall be resident. Now further, let's apply the additional conditions to determine whether she'll be an ROR or RNOR. Let's revise our conditions again, that if an individual qualifies as resident, the next step is to determine if he's a resident and ordinary resident or resident but not ordinary resident. Now, an individual shall be RNOR if he satisfies any of the one conditions, that he has been a non-resident in India for 9 out of 10 immediately preceding years. So of course, this condition is not satisfied because as our question states that she has not traveled abroad at all before 1st of May 2014, her residential status for those particular years will be resident only. So this condition of 9 out of 10 years that she has to be an NR is not satisfied. And the second condition, that has stayed in India for 729 days or less in the 7 preceding years. Again, even this condition is not satisfied because before 1st of May 2014, she was in India itself. So she has stayed for more than 729 days. So as both the conditions do not get satisfied, the residential status of Mrs. Kit shall be resident and ordinary resident. She does not qualify to be a RNOR. I am particularly, I have taken this example and I'm not applying the exceptions here just to understand the conditions thoroughly and for classifying into ROR and RNOR. So we are taking a plain example for this purpose without applying any additional provisions. Okay, next example, that Mr. Rashid was born in Lahore in 1948 and he has been staying in America for since 1970. Then he came to India to visit India on 2nd of October 2019 and returns on 31st of March 2020. So we have to determine his residential status for EVAC 2021. Okay, so let's not look at the solution directly, as he neither satisfies the first condition, like as he is born outside India and he has been staying outside India, and he came to visit India on 2nd of October and returns on 31st March. So he doesn't satisfy the first condition of being in India for 182 days, and neither does he satisfy the second condition, that although he was for more than 60 days, but in the last 4 years, he has not been in India for 365 days or more. So he does not satisfy both the conditions. And in such case, without applying any further conditions, we can state that his residential status is non-resident. Okay. Then moving on to the next example, Shane Warne, an Australian cricket player, has been coming to India since 1994-95 every year to play cricket and has been staying here for say about 4 months. So what shall be his residential status for AY 1920? Now, in this case, Shane Warne, he is an Australian cricket player having citizenship of Australia or a country outside India. But for the purpose of income tax, we shall be determining his residential status. And yes, as he is in India for more than 60 days in the previous year and was in India for more than 365 days in the preceding 4 years, because as our question has given that since 94-95 every year he comes to India to play cricket and he has been staying here for 4 months, that is for 120 days per year. So now, even though now our first two basic conditions that we'll go through, the first condition does not get satisfied, but the second condition, that is stay in India for 60 days or more and 365 days or more in the 4 preceding years, the second condition is satisfied because he is there for 4 months, that is 120 days per year, and the 4 preceding years that we have to check. So 120 multiplied by 4, that is 480 days. So he, among the two basic conditions, he fits into the second condition. And because he satisfies that, he shall be categorized as resident. Now, further, if we go on to apply the additional conditions to check whether he is a resident and ordinary resident or he is resident and not ordinarily resident, let's see, his residential status for AY 1920, we have determined that it is resident. And same, that he was a resident in at least 2 out of the 10 previous years, or other way stated that our conditions were that he should be an NR, right? Let's go to our flow chart, that he should be a non-resident in 9 out of the 10 previous years. So here your answer is no, because he is a resident India in all those years. And the next additional condition, that his stay in India should be less than 730 days in the 7 preceding years. Again, even this condition is not satisfied because he is staying for say 120 days into 7. So he is staying for more than 730 days basically. So his residential status shall be resident and ordinarily resident. Let's go back to our question. Yes. So he was in India for 730 days or more in the 7 preceding years, and hence he is a resident and ordinarily resident. So you see that even if he is a person staying outside India and he has a citizenship outside India, but in case of income tax, your residential status can come out to anything. And in case of Shane Warne here, he shall be a resident in India for our AYs, and if he generates any income over here, it shall be taxed accordingly. Shall be taxed as if he is a resident of India. Okay. Next example, the control and management of a HUF is situated in India. The Karta of HUF visited England with his wife from 14th August 2019 to 30th of June 2020. Earlier to that, he was always in India. So determine the residential status of HUF. Okay. So again, we'll review our basic conditions. Now, for determining the residential status of HUF, our condition was HUF would be a resident if its control and management is situated wholly or partly in India. Now, as the question states that control and management is situated in India. So our first condition is satisfied, and is the residential status shall be resident. Now, applying the additional conditions, we'll have to check, we'll have to apply those our conditions for individual. We'll have to apply it to the Karta of this HUF. That whether he was a resident in at least 2 out of 10 previous years. or like we have framed that NR for 9 out of 10 previous years. So no, he has always been in India before this period that is mentioned. He was always in India, so he cannot be a non-resident. Okay. And the second condition, of course, if he is in India itself, his stay in the last 7 preceding years is going to be more than 730 days. So the Karta is classified as resident and ordinary resident, and therefore whatever the residential status of Karta is, the same is applied to HUF, like we saw in our provisions. Therefore, this HUF, which is an resident HUF, shall be classified as resident and ordinarily resident. Now, in this case, if the situation was different, if the Karta, say, kept visiting abroad, or he does not satisfy any of the above conditions, say before the question, like it stated that he was always in India, if that was to be modified, and say in the last 4 years or 5 years he was staying abroad and then he came back to India, if any such of the case was, then the Karta would be classified as resident and not ordinarily resident. And if that was the case, then the HUF would have also been classified under our NOR, and the taxation, of course, would be different for in the both the cases. Then the next, because we saw provisions for each type of person, let's take example for each. Then a company which is incorporated in India, whose registered office is in America, has an effective place, its effective place of management in the previous year is in India. So for companies, what we have learned is, if it is an Indian company that is incorporated in India, or any other law governing companies in India, then it shall always be a resident. No matter where its registered office is, the Indian company shall always be a resident. Okay. Now, in case of a partnership firm, in partnership firm, there are three partners, namely A, B, and C. A and B reside in India, while C lives in Germany. The firm is fully controlled by C. During the previous year, Mr. C stayed in India for 6 months. Okay, so now we have to determine the residential status for a firm. So for a firm, what we learned is, a firm AOP or BOI, they are always a resident, unless if the whole control and management is outside India. Now in this case, A and B, the partners, now the control and management of a firm is in hands of its partners. So A and B reside in India. Well, Mr. C, he lives outside India, and the firm is controlled by him. But in the previous year, our relevant year, he has visited India for 6 months. So the basic condition that to be a non-resident, no part of control and management should be in India is not satisfied, because Mr. C has come, say for strategic meetings and everything, he has come to India and stayed in India for 6 months. Therefore, the partial control of the firm was in India, and the residential status shall be resident. So in this case, if Mr. C had not visited India at all, and all the control of the firm was done by him from a place outside India, only in such case, the firm would have been classified as non-resident. But the fact that he is coming to India changes everything, and the residential status turns to be resident. Lastly, a VIP club is in India whose director, Mr. X, belongs to China. The club is controlled fully by Mr. X in the previous year, and Mr. X did not come to India even for a single day. Now, in such case, a VIP club can be classified as, say, it could be an AOP, BOI, or it could be a firm. Applying those provisions to this club, it will be classified as non-resident, because even though the place of business was in India, no part of control and management was in India. It was controlled by Mr. X, who belonged to China, and he never visited India at all. So the club, even though in India or situated in India, his residential status shall be non-resident. Okay, moving on. Yes. Now this last example, I am going to give you all a chance to solve it and give me the answers, say in 5 minutes in our comment box. Because, oops, yeah, sorry. As this is an online session and we cannot make it very interactive, I thought this is our chance to involve everyone who is listening. And I think it will give me a chance to see if you all have understood the provisions and what I've said is clear. Yes, let's read the question. Mr. Dust left India for the first time on November 25th, 2016 for meeting his friends. Then during the calendar year 2017, he came to India on September 1st and stayed for a period of 10 days. Then during the calendar year 2018, he did not visit India at all, but finally came to India on 16th of January 2019. So determine the residential status of Mr. Dust for AY 1920. Okay. I will give you all say 3-5 minutes to calculate and then give me your answers in the comment box. If you want the provisions in front of you, let me know. I'll keep the flowchart open. Note down the question first. I hope everyone was ready with the pen and paper. This is just like a practice session for you before moving on to your quiz. Okay. For your reference, I'll just open the flowchart for a few minutes so that you can brush up the conditions or the provisions. Yes. I hope this helps. Okay. I have received one answer. Let's see, I'm waiting for others. See, in our day-to-day practice in our offices, we don't need to check the residential status for each and every client, but where we know that this particular client of ours, or particular SSC, who keeps traveling abroad or who say has employment for few years abroad, then comes back to India, in such transition cases, you have to check his residential status each year for say 3 to 4 years, where his residential status earlier, if it was non-resident, and then he comes back back to India permanently. If he shifts back to India permanently, then for the next few years, you have to determine his residential status every year, and then make sure that you are filing his IDR accordingly. Okay. Yes, I'll display the question again. Just a minute. Okay. I hope everyone is done. And even if not, let's go through the solution. I'll explain the solution. Let's see what answers we have got. Yes. Good. Okay. Let's take a look at the solution. The answers that I have got are correct and very good. So during the financial year 1819, Mr. Dust was in India for 75 days. And in the 4 preceding years, let's calculate his stay in India. That is for, now the question gives you information as per calendar year. But our provisions, you have to make sure that you apply it for you calculate it for a financial year and do not consider it into the calendar year process. Make sure you take your full year as April to March. So in the financial year 1718, he has stayed in India for 10 days. Like the question is specified in the calendar in the year 2017, he came to India and stayed for 10 days only. So in that year, his stay is for 10 days. Then for 1617, he has stayed for 239 days. And for 1516, he was in India because he has not left India before that. So full 365 days. And same for 2014, he was there for 365 days. So his total for 4 preceding years comes to 979 days. So he in our 2 basic conditions, he satisfies the second condition of being in India for 60 days or more, and in the 4 preceding years, he was there for 365 days or more. Okay, so as the second basic condition is satisfied, his residential status shall be resident. Now let's apply the additional conditions. That additional conditions that was, he has been a non-resident in India for any 9 out of 10 immediately preceding years. So was he? So no, because he was resident in the past years. So being NR, this condition is not satisfied. And the second condition, that he has stayed in India for 729 days or less in the 7 immediately preceding years, again, even this condition is not satisfied, because as we calculated in the 4 preceding years itself, his number of stay is for 979 days. So obviously the second condition is also not satisfied. And therefore, as he does not satisfy both the conditions, his residential status shall be resident and ordinarily resident. Okay, thank you. Now I'll take up the questions that I have received in the comment box. Okay, let me go one by one. Yes, the first question was, what is the reason behind verification process of ITR? So what happened was earlier, like in the past, say in the last 10 years or so, first the process of filing ITR was manual, and that time, uh, the say whoever tax consultants or the tax representatives, they could take undue advantage of the assessee and manipulate the returns basically. And even in the online form also, if someone has your pan, there could be a misuse of your information, and for that reason, say no one files your return on behalf of you, or your tax representative doesn't directly just file your return without taking information from you. This verification process is important to verify that particular assessee. So okay, so for that assessee also, to give him confidence that yes, my tax representative is filing my return with his consent basically. For that, e-verification has been made mandatory by the department, so that there are no other malpractices involved or no misuses done for, say, assessees who are not very aware of the income tax provisions. Our next question was, to verify ITR through EVC using bank account, can we use any of our bank account? Yes, you can use any of your bank account provided all your details match with the income tax portal. Okay, while filing, say, previous of your ITRs, you have mentioned, if you have mentioned any of the bank account, it is better you use that for, easy matching of the details. But yes, you can use any of your account. Do we have any demo site to practice filing of ITR? No, there is no demo site as such. Whatever filing of ITR can be done, it can be done directly on the income tax portal. What you can do is, for practicing, you can download the utilities in Excel format, like I had shown you earlier. You can download those. You can try to fill in the details for your practice, say from your own amounts, and so that you can get a hang of what the provisions are and what the schedules applicable are. But you cannot submit the ITR anywhere. There is no demo site as such. You can practice it through the utilities that are available, and the utilities are free to download for everybody. You just go to incometaxefiling.gov.in, and over there, the ITR forms are available for download. Is it possible to file ITR for financial year 15-16? No, you cannot file that previous ITR right now. But if you have submitted the ITR and you did not verify the same, e-verification of that is possible. Okay. Anyone has any more questions? You can shoot those right away. Let's wait for 2 more minutes, or I think we are done with the session then. Is there any way to check which mobile number has been registered? I think the best way is to visit an Aadhaar center, and over there you get all your information, and through that you can check what number was registered, and you can even change the number, but via Aadhaar center itself. You can give them the details, and I think you have to show them your PAN card as well. After giving those basic details, you can amend the number that is there, and you can check it as well, but by visiting Aadhaar center itself. Okay. Yes, okay. I think I missed your question earlier. Yeah, the residential status for partnership firm and LLP would be the same. Because both these categories are classified under the same type of person that we saw, that a firm. Firm includes partnership firm and LLP. So the residential status provisions would be the same for both of them. Okay, I think our time is up as well. Okay, I have one more question. Yes, so I think we can conclude our session.
Yes, ma'am. Surely. Thank you, ma'am. It was a great session. I hope you did justice to all the students by answering all their queries and giving us a vast view of the subjects. Now I request our CA Pushparaj Sanghvi for the concluding remarks.
Thanks to Sumira madam for sharing your valuable knowledge and experience with our students. Am I audible? Hello.
Pushparaj, you are
Yes, sir,
audible.
you are audible.
I'm sure that your inputs will really benefit them and they will make utmost use of it. Topic you have taken today is a very important topic because exam point of view, because lots of changes has been made in residential. Also, filing of ITRV and its verification process, it will definitely help article students during their office working. Definition of person, it's topic where students get stuck. Many times they will get confused over there. So your lecture will help them for clearing their basic doubts. We have to come to an end very a good session, and I believe everyone here will take something with them. Once again, a big thank you to Sumira ma'am and our participant for being active. I would also like to extend my sincere thanks to Pimpri Chinchwad branch and Vikasa team for honoring me with an opportunity to sum up this good session. Thank you all and all the best for your future. Thank you.
Thank you.
Thank you so much, sir. Now I request CA Shailesh Bore, sir, to add upon this. So you're on mute.
Yeah. Thank you,
Yes.
Sumedha, for such wonderful deliberation on the subject. It is the need of an hour because the skilled staff and skilled students are requirement of an office of a chartered accountant's office. You explain your subject in such a lucid manner that everybody is understandable. Thanks for accepting our invitation to be speaker in this direct tax practice course. We hope and confident that you would accept our invitation for future programs as well. I also thank you, CA Pushparaj Singhvi, for giving his valuable time for the session to be for concluding remarks and to express his views on the subject. I also thank you, Amul, and my other Vikasa team members for their in the session throughout the session and working relentlessly for the upliftment of the sessions. Now, I would request all the participants to join us tomorrow as a 9th day of the session, direct tax practice course session at 5 p.m. Thank you all. Thank you all.
Thank you, sir.
I would request all the panelists to please leave their screen so we can end the session. Yeah, Amu, there is no announcement, no, Amu?
No, that's it.
Okay. Thank you all. Thank you all.
Yeah. Okay. Thank you. Bye.
Thank you.